Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's look at the Canadian. And again, a similar logic. If you thought the dollar was going to rally back, you might buy some of these options that are in the money. We have the at-the-monies right here, the 105s, 105.5, and these are the out-of-the-money options here, Deck 107, 108, 109. The options get cheaper as you move out of the money. I hope that makes sense to everyone, because the delta, meaning that the rate of change of the option, will be lower. So if the dollar rallied tomorrow, let's say a point from 105.11 to 106.11, well, the Deck 109 call is only going to move up about 33 cents. And I'll show you where I'm getting that 33 cents from. That's called the delta. And if I thought the dollar was going to move down, I might look at the put options. So here we're looking at far out of the money options around the December 101. If I thought the dollar was going to break below parity, well, I could buy the Deck 101s, and your risk is 96 cents if you bought it on the offer, and the most you could lose is at 96 cents. Another question from Mary is, what are you controlling? You're controlling about 10,511 US dollars relative to the Canadian. So it's a great question, Mary. So puts are going to benefit if the dollar the U.S. dollar is going to continue to fall, and calls would benefit if the dollar was to rally. So what's been happening, as Jack pointed out, I can clean that up. Let me do that. So dollar is going to continue to fall. Well, you'd be looking at put options in both the Australian and the Canadian. That's the trend we've been in. If you're trying to trade sort of a counter trend or be a contrarian, you might want to look at call options. And I've got a question from Chalmers, what's the cost? The cost is going to be based on the strike price that you buy. So the deeper in the money call option is going to be $5.58. If I go to the Deck 105, that might be $291. When I say $291, that's $291 to control that 10,511. So I hope that makes sense. Move on to the dollar against the yen. And if you thought the dollar was going to continue to fall against the yen, what would you do? And I'm getting an answer. Put, of course. So if the dollar is going to continue to sell off, you might be looking at these put options. So any of these put options, you have out-of-the-money options here, you have at-the-money options, and then you have these in-the-money options. The in-the-money options are the most expensive. The out-of-the-money options are the cheapest. What if you thought the dollar was going to rally back? Well, if you thought the dollar was going to rally back, then you'd be looking at call options. So call options, and then you have to decide which strike price, and the strike price really creates your leverage. So if I wanted a lot more leverage, if I thought the dollar was going to make a big move, maybe I would buy the December 91 call or the December 91.5, some of these calls. If I wanted to buy the at-the-money, that'd be a little more expensive, about $280. And if I wanted to buy an in-the-money option, put up more nominal dollars with more risk, I might buy the Deck 84. And I could do the sort of the reverse. I could look at put options, out-of-the-money put options here, Deck 83s for 69 cents or $69. I could buy the Deck 88 put for about $1.99 or $199, or the in-the-money puts at $3.96. You'll notice that the bid-ask spreads are very, very reasonable. When you're looking at 5, 6, 7, 8 cents, that's a very reasonable bid-ask spread for options. So I hope that helps. The dollar against the euro, looking at the at-the-money option, and I'll go through the at-the-monies. Let's say the Deck 68 might be $1.26. The Deck 68 puts might be $1.41. in-the-money calls right here. In-the-money puts right here. So the in-the-money puts might be the DEX 71s. If you felt the dollar is going to continue to sell off, if you thought the dollar was going to rally and you wanted to buy a more expensive option, you might buy the DEX 64 or 65s. If you wanted a leverage proposition in calls because you thought the dollar was going to rally, you might look at the DEX 70 calls. They were trading at around 58 cents. Look at the deltas. That's going to be your responsiveness to changes in the underlier. So this is going to move 88%. That delta is essentially a percentage. In the DEX 64s, that's why it costs more money. The DEX 71 is only going to move at 20%, but that's going to change each and every day. And if I wanted to look at put options, if I thought the dollar is going to really sell off and I wanted to find a leverage proposition, I might look at the DEX 65s, DEX 66s, DEX 64s. So lots of ways to trade it. Again, if you're looking at the trends, and you believe in the trends, you might be looking at put options. If you thought you wanted to play more of a contrarian view, you would probably or possibly look at call options. So, just a couple of ways to trade this. I want to remind everyone that Jack offers a free daily global macro commentary each and every day, and that could be sent to your email box. I find it very valuable, great insight each day, as I've signed up for it, and I'd urge everyone here to sign up. He also has subscription-based letters. So whether you're looking to trade options, spot or futures, emerging market currencies, or currency ETFs, he offers various services, and Jack can go through that, or actually you can go to the website and you can see the pricing for all that, but I would highly recommend that you sign up for the free global macro commentary. It's called Currency Currents, and you could get that at blackswantrading.com. You just sign up. It's as simple as that, and you'll read Jack and his son, JR, each and every day. They have some very, as I said, insightful information. If you found today's presentation to be valuable, then you will, I'm sure, really love his daily Currency Currents, and then you might want to sign up for the subscription-based letters. So why don't we take some questions, Jack? Again, I want to thank you. Great presentation today.
Thank you, Steve. I appreciate it.
I always learn something every time that you join us here at the IC, so thanks again. Let's see. See if we get a question. From before. Jack, Leaf wants to know, if you wanted to trade short term, what would he want to, what would he be looking to trade? And is there anything that is magical about a certain moving average? I guess it's a two-part question.
Yeah, I think I read his question. I think one of his concerns was, can you use these, in these short-term time frames? And I think we tried to answer it. Just because of the pricing, when I say short-term time frames, I'm defining that as intraday, something or, very close to intraday or 1 day, 2 days at the most. And those types of time frames, people usually trade currencies in the cash market because the spread is very tight and it's extremely liquid and they can get in and out in a moment. With the options, as we talked about, have wider spreads and they just don't lend themselves for those time frames. So my intermediate term time frame is many days, to weeks, and then the longer term time frames is many months is how I would define them. And I think the intermediate to longer term is where we would use this product. So that's what I meant there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.